Welcome to the Accounting Desk, your essential guide to unlocking insights in public sector accounting. Today, we embark on a journey into IPSAS 15, a standard designed to enhance transparency and understanding for financial instruments in public sector financial statements. Are you ready to demystify these complex disclosures? Let's begin. At its core, IPSAS 15 is about clarity. It provides a framework for the presentation and disclosure of financial instruments, ensuring that public sector entities communicate clearly with their stakeholders. This standard guides you through loans, receivables, derivatives, guarantees, and even exposures to market fluctuations. As we progress, you will discover how IPSAS 15 reinforces transparency, making financial statements not only compliant but also insightful. Our exploration will follow a logical progression. We start with the objective and scope of IPSAS 15, then delve into definitions and classifications, explore critical disclosure requirements, and finally, illustrate its practical application through a realistic case study. Each section is crafted to offer a clear understanding that builds up gradually, answering your most pressing questions about financial instruments in the public sector. The objective of IPSAS 15 is straightforward, yet vital. It seeks to enhance financial statements by ensuring proper presentation and robust disclosure of financial instruments. Organizations must disclose relevant details, thereby providing stakeholders with insight into underlying risks such as credit, liquidity, and market fluctuations. This commitment to transparency not only builds trust, but also facilitates better risk management and decision-making. By offering clear guidelines, IPSAS 15 elevates the quality and reliability of public financial reporting. The scope of IPSAS 15 encompasses a wide array of financial instruments, yet it is precise about its limits. The standard applies to almost every financial instrument encountered in the public sector, from cash and receivables to bonds and loans. However, there are exclusions. For instance, interests in subsidiaries, employee benefit obligations, insurance contracts, and lease agreements fall under different standards, such as IPSAS 6, 7, or 13. This careful delineation helps you understand exactly which instruments must be reported under IPSAS 15 and which require separate treatment. Understanding the purpose behind this standard brings us to a fundamental question. What constitutes a financial instrument? A financial instrument is defined as any contract that generates a financial asset for one party and a financial liability or equity instrument for another. This definition may seem abstract initially, but it lays down the essential foundation for accurate classification and disclosure. Whether it's cash, a receivable, government bond, or a loan, every financial transaction fits into this framework. It is the diversity of these instruments that underscores the need for a robust reporting standard to decipher their true impact on financial statements. Let's now explore the various types of financial instruments. They are broadly categorized into financial assets, financial liabilities, and derivatives or net assets. Financial assets include items like cash, receivables, investments, and other monetary resources. Financial liabilities, on the other hand, pertain to payables, borrowings, or obligations that an entity must settle. Derivatives or net assets, such as interest rate swaps or currency options, add a layer of complexity given their unique risk profiles. Picture a classification table clearly outlining these categories, and you will have a solid visual aid for internalizing these concepts. This organization simplifies your learning process and assists in aligning financial instruments with their appropriate disclosures. Now, let's shift our focus to the presentation of these instruments within financial statements. The first step in presentation is classification. Different financial instruments are classified into three fundamental categories: financial assets, financial liabilities, and net assets or equity instruments. For example, consider a city government that receives a loan. This loan is classified as a liability. In contrast, if a public entity invests in a state-owned bank, that investment is recorded as an asset. Understanding this distinction is crucial because it dictates the presentation approach and the level of disclosure needed for each category. Offsetting is another important aspect of IPSAS 15. You must remember that offsetting financial assets and liabilities is allowed only when there exists a legally enforceable right. and when there is an intention to settle the amounts on a net basis. For instance, if you have a receivable and an opposing payable with the same counterparty, offsetting may be applied if both parties agree under a master agreement. This rule provides clarity and prevents misrepresentation in financial reporting. As we move beyond the classification, let's examine the disclosure requirements that serve as the cornerstone of IPSAS 15. The standard demands that public sector entities disclose both the nature and the extent of risks associated with financial instruments. These include credit risk, liquidity risk, and market risk. Imagine a scenario where a ministry holds foreign bonds. They must clearly disclose any exposure to exchange rate movements and potential market fluctuations. This information is critical for stakeholders to assess risk and understand the financial stability of the entity. In addition to risk disclosures, it is essential to detail your accounting policies and categories. The standard requires that you explain your accounting policies for financial instruments, clearly state the categories of financial assets and liabilities, and discuss the measurement basis employed, whether it is fair value or amortized cost. This transparency fortifies your financial reporting, ensuring that users of the financial statement are fully informed about the methods used in determining values and risks. Speaking of measurement, another important element in IPSAS 15 is fair value disclosures. Whenever it is possible, entities should disclose the fair value of their financial instruments. If you find a discrepancy where fair value does not align with the carrying amount, an explanation is necessary. Consider an investment in unlisted shares. Such assets might require estimation techniques that differ from standard market values. Explaining these discrepancies equips your audience with a deeper understanding and allows them to reconcile differences effectively. Incorporating practical applications rounds out the learning process. Let us consider a case study involving a public utility company that receives a concessional loan of $10 million. In this scenario, the loan is recognized as a financial liability. However, if the loan offers an interest rate below the prevailing market rates, the entity must disclose this concession. They are required to provide a fair value estimation along with the associated risks, thereby ensuring that the unique nature of the instrument is fully understood. This case study is a tangible example, illustrating the necessity of detailed disclosures and fostering transparency. The practical implications of IPSAS 15 extend further. When you deal with complex financial instruments, remember to disclose not only the numbers but also the risk exposures and the judgment used in assessing fair value. This level of detail is essential for stakeholders, enabling them to make well-informed financial decisions. It also reflects a commitment to deep, honest communication that goes beyond numerical data. In a way, this approach bridges the gap between theoretical standards and practical, real-world application. Let us now review the overarching framework of IPSAS 15 as it applies in public sector accounting. In every financial statement, IPSAS 15 ensures that the emphasis is on transparency and detail. There is a constant interplay between the classification of instruments, the way they are measured, and the comprehensive disclosures provided with them. Each component interconnects to form a coherent narrative about the financial health of an entity. This systematic approach not only builds trust, but also aligns with modern demands for accountability and integrity within public sector financial reporting. Each step along this journey holds significant importance. The objective and scope set the stage, while definitions and classifications provide a clear pathway to understanding. Disclosure requirements open up the narrative to the transparent communication of risks and policies. And finally, the practical application reminds you of the real-world impact of these standards. By systematically breaking down IPSAS 15 into digestible segments, you are well equipped to apply these principles in your daily professional activities. The intricate details of IPSAS 15 may initially seem daunting, but with systematic study and application, these guidelines become a powerful tool in fostering trust and clarity. Embracing this standard transforms raw financial data into meaningful insights. It empowers you to communicate not only numbers, but the underlying story of financial health and risk management. This standard ultimately raises the bar in public sector accounting, making financial reporting more robust, transparent, and reliable. Let's pause and reflect. Imagine a public sector accountant facing a complex financial statement. IPSAS 15 provides the necessary framework to navigate these complexities confidently. The careful disclosures, precise classifications, and clear definitions all work in harmony. This compliance is not just about following a standard, it is about enhancing transparency and accountability. Thus, every element of IPSAS 15, from risk disclosure to fair value estimation, plays a critical role in the broader narrative of financial governance. In summary, IPSAS 15 is a comprehensive standard designed to illuminate the intricacies of financial instruments within public sector financial statements. It emphasizes clarity in presentation, comprehensive risk disclosure, and detailed accounting policies. By breaking down the concept of financial instruments into clear categories and providing specific guidelines for disclosures, this standard transforms complicated financial data into accessible information that stakeholders can trust. Every public sector accountant, financial analyst, and student of financial reporting stands to benefit from a solid grasp of IPSAS 15. Not only does this standard secure compliance with international best practices, but it also reinforces the trustworthiness of public financial reporting. The detailed guidance provided ensures that every financial asset, liability, and equity instrument is reported accurately and transparently. In practice, this means that each financial statement becomes a testament to open governance. As we close our discussion, remember these key takeaways. IPSAS 15 is not merely a set of rules, it is a commitment to transparency and accountability. It bridges the gap between raw financial data and clear, actionable insights. Each section, from objective to disclosure, is crafted to build your confidence and competence in handling public sector financial instruments. Your journey to mastering IPSAS 15 begins with understanding its objectives, appreciating its scope, and applying its principles with precision. Every concept supports the overarching goal: to make financial reporting more reliable and transparent for all stakeholders. Embrace these guidelines to build a narrative of clarity and trust within your organization. Thank you for joining us on this journey into IPSAS 15. Your commitment to learning and applying these standards is a step towards more trustworthy financial communication in the public sector. Discover more insights and deepen your expertise by staying engaged. Subscribe and hit the bell for more IPSAS walkthroughs.